Brazil currently has an interest rate of 15%. Yes, 15%. That number alone already sounds extreme, but it becomes even more shocking when you compare it to most developed countries, where interest rates usually stay between 4 and 6%. In practical terms, this means that borrowing money in Brazil is incredibly expensive, saving money pays unusually well, and the entire economy operates under a constant brake. So the big question is, why does Brazil need such an absurdly high interest rate while countries like the United States can function with much lower rates? To understand this, we first need to understand what an interest rate actually is. An interest rate is essentially the price of money. When interest rates are low, borrowing is cheap and people are encouraged to spend and invest. When interest rates are high, borrowing becomes expensive, consumption slows down, and economic growth is restrained. Central banks use interest rates mainly to control inflation, stabilize the currency, and manage the pace of economic growth. In Brazil, the main interest rate is called the Selic rate, and it is set by the Central Bank of Brazil. In the United States, the equivalent is the federal funds rate, controlled by the Federal Reserve. The most important reason Brazil has such high interest rates is inflation, especially Brazil's long and painful history with inflation. Brazil did not just experience inflation in the past, it experienced hyperinflation. During the 80s and early 1990s, prices in Brazil could double in a matter of months. People rushed to spend their money as fast as possible because holding cash meant losing purchasing power almost immediately. Salaries were constantly adjusted, contracts were indexed, and saving money made no sense. This period destroyed trust in the currency and deeply shaped the economic behavior of the country. Even though inflation was finally brought under control in the mid-1990s with the Real Plan, the memory of hyperinflation never disappeared. Because of that, policymakers, investors, and consumers in Brazil are extremely sensitive to any sign that inflation might return. As a result, interest rates in Brazil function as a defensive weapon. The central bank reacts aggressively to inflationary pressures because letting inflation escape control would be economically and socially disastrous. High interest rates reduce consumption, slow down credit growth, and help keep inflation in check. At the same time, they help protect the Brazilian currency. Brazil is far more vulnerable to capital flight than developed economies. If interest rates fall too much, investors may move their money elsewhere, the currency can depreciate rapidly, imports become more expensive, and inflation rises again. This creates a dangerous cycle that the central bank is constantly trying to avoid. This is where the comparison with the United States becomes very clear. The US dollar is the world's reserve currency. It is used in global trade, international reserves, and financial markets all over the world. Because of that, the United States does not need to defend its currency in the same way Brazil does. When global uncertainty rises, investors often move money into US assets, not away from them. Brazil, as an emerging market, does not have that privilege. It must offer high interest rates to attract and keep capital. Another major factor behind Brazil's high interest rates is government debt and fiscal risk. Investors care deeply about whether a government will be able to pay its debt without resorting to printing money. Brazil has a history of high public spending, rigid budgets, and frequent fiscal uncertainty. Political instability and changing fiscal rules increase doubts about the long-term sustainability of public finances. Because of this uncertainty, investors demand a higher return to lend money to the Brazilian government. This extra return is known as a risk premium, and it directly pushes interest rates higher. The United States also has a very large amount of government debt, but the perception is completely different. U.S. government bonds are considered some of the safest assets in the world. The U.S. borrows in its own currency, has deep and liquid financial markets, and enjoys a very high level of institutional trust. Investors believe that the U.S. government will honor its debt, and that belief allows the country to borrow at much lower interest rates. Brazil, unfortunately, does not yet have the same level of trust. Institutional credibility plays a huge role in this story. The Federal Reserve has spent decades building credibility. It is seen as independent, predictable, and committed to controlling inflation. When the Fed signals that it will act, markets believe it. The Central Bank of Brazil has improved significantly over time and gained formal independence, but credibility is something that takes decades to fully build. Political pressure, public criticism, and historical instability still affect market expectations. Because credibility is lower, interest rates have to be higher to compensate for uncertainty. Brazil's financial structure also contributes to high interest rates. It has relatively low domestic savings, high banking spreads, limited competition in the credit market, and less access to long-term financing. This makes money naturally more expensive throughout the economy. Even when the central bank lowers the benchmark rate, loans and credit for consumers and businesses often remain very costly. In the United States, capital markets are deeper, competition is stronger, and banks operate with lower spreads, which helps keep borrowing costs lower across the economy. Another key concept is inflation expectations. Central banks are not only fighting current inflation, but also what people expect inflation to be in the future. In Brazil, inflation expectations tend to rise very quickly. Businesses adjust prices faster, workers demand higher wages sooner, and many contracts are still indexed to inflation. This creates a self-reinforcing cycle where expectations push inflation higher, forcing interest rates up again. In the United States, inflation expectations are more anchored because people trust that the Federal Reserve will maintain price stability over time. That trust allows interest rates to remain lower. So when we compare Brazil and the United States, the difference becomes clear. Brazil carries the weight of hyperinflation history, a more fragile currency, higher fiscal risk, emerging market status, and lower institutional credibility. The United States benefits from being the issuer of the world's reserve currency, having deep financial markets, strong institutions, and a very high level of trust. Interest rates are not just about numbers and equations, they're about confidence. Countries with less trust must pay more to borrow. High interest rates in Brazil are a double-edged sword. On one hand, they help control inflation, stabilize the currency, and attract foreign capital. On the other hand, they slow economic growth, discourage investment, and make life more expensive for households and businesses. Brazil constantly faces a difficult trade-off between stability and growth. The United States has more room to manage this trade-off because it faces fewer structural risks. The big question is whether Brazil will ever be able to sustain low interest rates. The answer is yes, but not quickly. For that to happen, Brazil needs long-term fiscal discipline, stable and predictable economic policies, higher productivity, deeper financial markets, and most importantly, trust built consistently over many years. Countries do not magically achieve low interest rates. They earn them over time. In the end, Brazil's 15% interest rate is not the result of a single policy mistake. It is the outcome of history, inflation, risk, credibility, and economic structure. The United States pays less to borrow not because it is perfect, but because it is trusted. And in economics, trust is one of the most valuable assets a country can have.